Ready to start? Good evening, everyone. I'm Brad Gecelter, and welcome to another wonderful YJP event on demystifying the share market. It's great to be joined by our four expert panelists, who I will introduce you to in just a moment. I thought I'd give you a little bit of a quick intro into why and how this event came about. All listeners here no doubt have a great interest in the market, or would like to obviously obtain a bit of an interest into the market. However, there's continuous confusion, I guess, frustration, and just plain old ambiguity about what is actually happening from time to time. The share market really is its own beast, and when we look at the performance over many years, it raises the questions on what tips can these experts provide, and is there anything that I should be or could be doing to ensure more stable or efficient trading and returns? Finally, a few words of thanks to Brian Berger for being an absolute champion when it came to setting up this event. We actually discussed this last Tuesday, so in a week he's done some fantastic work, so thank you very much. Zellman for making this live, who no doubt is doing a great job, and thank you for that. And to our absolute four expert panelists who will get started and get you into it. So I think sort of the best way to start, guys, if you don't mind, is just to really give us an overview of your role in the industry and you know, what you do currently today. So Niv, if you don't mind starting, we'll get you underway, which I'm sure you'd like.
Yeah. Hi everyone, Niv Dagan from CoPeak. So my background did my Bachelor of Commerce and Honours in Finance at the University of Melbourne. I then got a job as a young trader at Macquarie Bank, worked from 2006 to 2010. Really interesting time, and I'm sure we'll talk about the GFC, and Rafi and I had a bit of a laugh before, but interesting time learning from a lot of very smart people around, in similar sort of context as today. Then went to a group called HC Securities. I ran the broking side at the age of 26, 27, which was great experience. And got sort of sick and tired of corporate world and set up CoPeak. So CoPeak, we're a small boutique investment management corporate advisory business. Everything that we do, we back with our own capital. So whole models based on co-investing, which means that we don't put opportunities in front of anyone. So whether it is an L1, or a 180 or a Brad is a high net worth unless we're backing them with their own capital. We're sector agnostic, so we look at anything from AI, machine learning, to candy subscription businesses, to blockchain, to hemp and CBD business.
Right.
I was fortunate enough to spend 2 years in Vancouver, growing a North American distribution, so got a great network over there in North America. Yeah, really excited to be here today. So thanks, Brad. Thanks for
Thank you, Niv. Wonderful. Shaun.
Thanks for having me.
Great.
Yes, I'm Shaun Factor, co-founder of 180 Markets. 180 Markets is a capital raising platform that allows brokers and companies to share their deals online. We also do our own deals too. My background is in share trading, so I went straight out of uni into pretty much full-time day trading, and have done day trading, short-term trading and a bit of investing for about 18 years now. And yeah, about 6 months ago, I just needed to do something different, so yeah, got into, I guess, Niv's game and into the whole capital raising area. So yeah, Niv and I usually sit a bit closer, but we've moved a bit further apart.
stay away.
Yeah, so
Excellent.
no, it's good to be here, and we'll go through it all later.
Thank you, Shaun. Perfect. Natasha, thank you for joining us as well.
Thanks, Brad. Natasha, Mandie. I'm the Managing Director of EM Advisory. We're a boutique corporate advisor that really focus on 3 things around growth strategy, capital raisings and M&A, predominantly in the technology sector, but also in food and beverage industrials across both listed companies and unlisted. We do transactions between, call it $2 and $100 million, and our focus is on partnering with vibrant and purposeful companies, investing in their businesses and helping them grow and helping them have better choices around capital. So we've raised money from the US, from New Zealand. We have a transaction closing, a $5 million transaction closing at the moment in New Zealand. Today, we raise money here in Australia, out of Europe and out of Asia. So it's all about choice for founders and helping them, one, get the right strategy for their businesses, and two, get the right capital structure or the right M&A transaction to help them realise their value. So we've got, it's been a busy time. Thank you for having me.
Great. Wonderful to have you. And Rafi, thank you for joining us as well.
Thanks, guys. My name's Rafi Lamm. I'm a co-founder of L1 Capital. I set up the business with Mark Landau back in 2007. We're an Aussie equities fund manager initially, and now we've got a number of strategies. We have a long-only Aussie equity fund, we've got a long-short fund that invests both here and offshore. We've got a listed version of the long-short fund, and we've got a team that runs the international long-only fund out of Sydney. We've got a team in an office in London doing property in the UK, and we've got a team in New York doing special opportunities globally. Day to day, my role, along with Mark, is running the investment team for the long-only fund and long-short fund, and personally I spend most of my time covering the materials, oil and gas and mining sectors.
Excellent. Perfect. Thank you, Rafi.
Pleasure.
Great. So as you can see, we've got a pretty phenomenal panel here that's going to give us a bit of a variety of answers to some of the questions that we'll have, and hopefully later on, if we don't sort of take too long, we'll open up for some questions, which I'm no doubt sure many of you will want to get underway and ask once we've finished up some of the questions that I have for you guys. So I think we should start by really, one of the questions that I'm always sort of interested in is how do you start? If we look back, I think the first share I ever got was Telstra shares when I had my bar mitzvah. Okay, I don't hold them anymore, but yeah, I think there might be many people in that category. But how do you start? If I said to you, Rafi, what was the first thing that you ever bought? When you looked at the market, what was the first thing you did?
So, a little bit like yourself, I think the first share I bought was Tabcorp in the privatisation, and like everyone used to fill out a couple different forms to get in a couple different names. And I remember coming in on the first day the trade to school and telling my mates about how this great scam of Aussie privatisations, and that's maybe piqued my interest a little bit initially. In my professional career, I started off at a firm called Cooper Investors, led by a guy called Peter Cooper, who's a bit of an Aussie investment legend. And day one, I didn't really know what I was doing, but just a couple months after I started, I went up to Sydney for an investor day for a firm called Baycorp Advantage. It was a stock that we held in the portfolio. It was quite a hot stock at the time. And I listened to the first hour or two of presentations, and I was highly unimpressed. There was a lot of hype, but very little attention to detail. The business plan wasn't clear and coherent. The cash flow didn't meet the earnings. There were lots of one-offs. The people weren't that impressive. And at morning tea time, I gave my boss, Peter Cooper, a call and just to give him an update on the presentations. And I said, this is a pretty shitty company. It happened to be in the portfolio. And he said, well, should we sell it? And I said, I've never had to make that decision before. He's like, well, now's the time. And so actually the first decision I made in the investment management world was to exit a position to sell our Baycorp Advantage. The stock went down much more than 50% over the next year, and that really gave me a bit of confidence to go on my way.
Absolutely, fantastic. And Natasha, did you sort of have a similar experience when you first looked at the market and wanted to sort of have a go, or should I say have a punt or have a go?
So I joined Macquarie when I was 21, and I worked in their equity capital markets division, and the very first deal I worked on was the dual listing of Looksmart. And that was a business with a lot of hype, huge valuation, a lot of profile, a lot of investor interest. There was more buying in Australia than there was on the NASDAQ for that stock. And like everyone in the team, we bought in. It was a time when in ECM you could invest in the deals you worked on, and we all applied. And I remember thinking to myself, I didn't really understand investment, I was starting to understand a little bit more about how to put together a deal, and I sat through an investor presentation when the CEO came to Melbourne, and I remember thinking, I think I should sell some shares. Like I don't think I should hold this anymore. And I spoke to some of my colleagues, and they said, "Oh, but you shouldn't sell all of them. You should sell half." So I took I think I invested $2,000 because I had no money. My $2,000 had become $7,000, $10,000 I made, $3,000 on my position, and I kept the rest. Long story short, the rest of my stock went to zero. The business died. About a month later, the tech wreck happened, and really there was no ability to sell out after that. It was just this catastrophe in the share price. And I think it really demonstrated to me that I think if you've made a decision to exit a position, you should exit, but also that you should understand the stocks you invest in. You should never buy a stock unless you really understand what their business model is. And I've done a lot of work with one of the co-founders of Looksmart. He's a long-standing client, and he often talks about how Looksmart, the business that Looksmart was in, was keeping investors happy. It didn't actually have a business. Now, it wasn't alone in the first tech boom to have that business model, but you should understand the business that the stocks you invest in, because that's really the stuff that will determine long-term value, not the short-term trading price. But anyway, it was an interesting lesson.
Interesting. I think that's going to be a good discussion shortly when we talk about long versus short. Do we hold things for long or do we hold things for short? So we'll come back to that. But I'm interested to know, Shaun, your story when your first share you bought in post uni or during uni.
So I actually didn't buy my first share, my dad did. So he took my bar mitzvah money, which I think was about $5,000, $6,000.
Gee, you had good guesses at your bar mitzvah.
Yeah, I did. He put that into blue chips.
Yeah.
And I think it was 99 was a tech boom, and every other share was going up a lot more than my blue chip portfolio. I remember calling up my dad and saying, okay, I'm selling all these big stocks and going into these speculative ones, and he was like, no way, don't you dare, don't touch it. But I did. The first share I bought was Optus. I still remember the code CWO, Cable Wireless Optus. And I did buy shares in Looksmart, like Natasha as well. And I remember in that time, I think it was 99, 2000, I used to skip uni classes to go to the ASX building in Collins Street. I used to go with a mate, and they used to have the only live platforms. It was called Bourse Data, which now everyone's got. And just the excitement that I used to get just from going to that building and watching the shares. I mean, it was like a casino, because it was a tech boom, but everything was going up. So yeah, I just got more and more active in these stocks like Looksmart and a few others, Secure Networks, Avnet, and as Natasha said, they probably didn't have a business, but it was just about getting the share prices higher and higher. What happened next? The tech boom ended, and it wasn't that fun after that. But, good times.
Absolutely, it would have been.
Yeah.
Excellent. And Niv, I remember catching the train with you, to work on the odd occasion. I was in the city and you were in the city, and this was the time I think we were a bit pre-tech boom maybe.
I think so, yeah.
Yeah, just a bit pre-tech boom, and we were talking about all the resources stocks. So you certainly did well. So I'm keen, and I'm sure the viewers are keen to know sort of what you did first. Well, you told me you did well anyway.
Yeah, we only talk about the winners, not the losers, and that's the problem probably among the panel. But no, look, I knew for a fact that going to university was always interested in the stock market. I remember I had a job at Make-A-Wish Foundation, right out of university, and after after a shift on the phones, I used to come home and literally Google search stocks and look at incredible charts and look at technical analysis, and got really into it. And then I got an internship actually at Mentor, and for everyone that's interested in Mentor in terms of nothing against Mentor, but I was always looking at stocks while actually at Mentor, which shouldn't. And at that point in time, I knew that that was my passion. And I still remember we used to have a competition with another guy who now runs the options desk at UBS Warburg. His name's Michael Abusayev. And, we used to skip classes and actually go to the computer room at university and literally just trade all day. So look, always had a passion for it. Interesting, how the market is very, very similar right now. And, there's a lot of ups and downs, definitely.
Excellent. I think one of the key things that I've heard around, and this might sort of lead into the next question, is people have been at home for the last 3 or 4 months or so, and we've seen a lot of stuff, looking on face value, and logic should tell us the market should be absolutely in despair. They really should be. But there's been a lot of people at home, and then a lot of people wanting to invest and probably have tested the waters. I mean, as an example, I certainly have. I haven't been in stocks much for the last few years, but now being at home. I think you only hear about the successes from people. You never really hear about the loss, the failures. And I think that's something that I'd love to discuss is, I'm sure you all, and I know you all have had great success, but some of the failures that people can have and, you've had, I think the listeners would like to hear that, because it's not all just glory out there, I think.
Yeah, look, I mean, a lot of what we do is we back the management teams, right? Probably similar to Rafi, where you're sitting in a room and Natasha and my favourite question to ask management teams is always, how much do you pay for rent? Because you get a good feel if they overspend or you don't, if they're cost conscious or not. I mean, I still remember the time, and we talked about this just before, Brad, that I was sitting down with the CEO of a small mining company. It was a $3 million mining company. He's trying to, tell us how often he travels to Mozambique, 12 times a year or so. And then I had a bit of a laugh. I said, do you travel economy or business class? And he goes, no, I travel business class. And I'm thinking in my head, God, this is a $2.5–3 million company. So I'm going to invest and actually go, So it's really important to back the management teams. I think that's a really key rule. But in terms of successes, lots of successes. But in terms of failures, lots. I mean, give you an example. One of my biggest, call it paper losses, and still is a company called Neuron, which is a biotech company. They were leading into their phase 3 trials. I don't have a really strong background in terms of biotechs, but there was a lot of chatter about a deal and a deal. So everyone was going in and buying the deal, and the deal did come. But the upfront component was very, very small. It was only 10 million, and the market, I think, was expecting 100 million plus. The stock went from $3 to $1 in the space of, overnight, right? And that comes down to how do you position that, right? So a lot is obviously backing management, cutting losses where you can early. It's really, really important, but you definitely don't always get them right.
Yeah. And obviously, Shaun, you mentioned the tech boom. You were probably, it was like you said, a casino, and then bang. Yeah.
Look, I'll start on the whole learning thing from a quote that most people would have recently probably reheard during the Michael Jordan documentary. I've failed so many times, I've made so many mistakes, and that is why I succeed. So Michael Jordan used that philosophy throughout his basketball career. And I think anyone that wants to start out on the stock market has to have that going in to when they start, because I think the only way to learn is from your mistakes. And as long as you can afford to make those mistakes and carry on, then it'll put you in good stead going forward. So, look, I've made heaps of mistakes. I make mistakes every day, but the most important thing is that you learn from it. So in terms of biggest losses, I've also had a lot of big ones, but I mean, in terms of, this is not a dollar big one, but one of the worst losses I had, one of the most frustrating ones, was when I was in a biotech as well, and I was holding overnight when I shouldn't have been holding overnight because I hadn't done my research properly and results were coming out. But I don't know, maybe I was just a bit off that day, and I was holding a pretty decent amount overnight, and they came out with their results, and the next morning it opened down about 80%.
Wow.
So that's pretty common in small cap world. it's you see movements like that every day almost. You
Definitely.
just hope that over the long term you get more ups and downs when. But yeah, I mean that one was really bad because I didn't do my homework and I got caught out badly. So had I done my homework and made a wrong decision but backed myself, it would have been fine. But because I was a bit slack, that's the most frustrating part.
Interesting. Yes, I guess the homework is important.
It is.
It's very important.
Yeah.
And Natasha, I mean,
that business models aren't validated, then you're taking a risk on their ability to execute, you're taking a risk on management, and you're taking a risk on how they're going to actually perform and what they're going to do relative to what they say. And you can do all the due diligence in the world, but if the next day they do something different, then it's going to be, it could be adverse. And so I think you learn from the times when you lose. And I think I have a position, I actually, in this case, I didn't actually lose money, but I lost 18 months of my life trying to save a business and then exiting. Now my investors we led around into a company and the CEO stole the money. And it took me about 3 months. I was chairing the company and it took me about 3 months to realise that the money was gone. And the guy who was ringing me and telling me he had no money had actually taken it and built a house and a pool and a very nice kitchen for his wife. It wasn't a very pleasant experience. And I was very new. I started my own business. I was 27. I was running my own advisory business. I was doing investing. I was leading syndicates into private companies. I was doing the due diligence. And I remember that the guy I was working for at the time said to me, I'd spent about 4 months doing due diligence on this one, and I'd come to him and said, look, we just don't have answers for some of the questions. And there's two potential answers to why. One is that he's super disorganised. And the second answer is that he's a crook. And I can't tell you which one it is. He's a really good guy. We've experts checked in. We've checked him out. We've done everything we can possibly do. And this guy looked at me and said, if you don't make this investment, you can write off your quarter because you've basically spent the whole quarter looking at this investment. It's the worst advice I ever got. So I did the investment. I thought, what choice do I have? I have to do this investment. I led this syndicate of investors in, and in 3 months it was a catastrophe. Spent the next 18 months basically getting out, and I managed to get my investors out. They had a 33% IRR, managed to get my own equity out. It was nothing short of a miracle, but the amount of blood, sweat and tears was completely disproportionate to the actual investment. And what I learned really, really well was a couple of things. One, if you're thinking about fraud, don't invest. There's no, like, if your head is going that way,
interesting.
then it doesn't matter how sweet the guy is and how credible he seems and how many positive. Ironically, I rang his referees after we found out about the fraud and said, oh, look, by the way, I just wanted to let you know you gave this guy a great reference, but actually it was pretty messy, and he stole money from the company. And he goes, oh, he did that to us too. I'm like, what do you mean? I asked you the direct question and you, oh, well, I didn't want to mess up his opportunity. I figured everyone deserves a second chance. And I'm like, I'm an idiot. So what I learned was anyone who, if your head is even going towards fraud, don't do it. Two, the point of due diligence is to walk away if you find some things. So if you're nervous, if due diligence hasn't stepped up, follow your gut because it means you shouldn't do it. Okay, you can't always cross the I's and dot the T's. You can't always prove the answer. So there needs to be a question of judgment. And three, anyone who doesn't pay their staff super is effectively a crook. And that's the easiest way to tell if someone's lying because that's where people tend to start, that kind of thing. So if cash is tight, they'll stop paying their staff or they'll stop paying their super. That's really adverse. So when you're looking at an investment, you're looking at a due diligence, yes, ask about their rent, ask them about their super. So because that's where that's a big lump of money, and that's where if they're going to cut corners, they tend to. So I learnt really strongly that what you shouldn't do. So yeah, that was a messy one. I remember that one a lot more than you invest in things and they fail, and time passes and the pain of the loss passes. the lessons I learned on that investment, I remember to this day.
You probably would remember that more than some of the wins that you've had.
Oh, absolutely.
Definitely.
The thing about a win is you just never know why you had the win for sure. So you could have been in the market, like Shaun was saying, you could be in a good time in the market where prices and valuations are going up and you've had a good opportunity. When you lose, you think about why you lost because you've got to learn. And like Shaun said, you've got to learn from your mistakes. You've got to derive insight from what's happened. And so, yeah, the losses tend to stay with you longer than the wins. Now, the challenge as humans is exiting positions when you have losses and actually realising losses, because no one likes to crystallise them. Everyone thinks, oh, maybe that will come back.
Yeah.
But you have to have a view on the underlying value. Like I said, you have to have a view on the underlying business, and you have to have a view on the people. And if it doesn't stack up, then you should walk away.
Yeah, excellent, very true. And Rafi, so you made a good call straight up with Bay Corp Advantage. You know, that was a really good call.
Right, so the danger with good calls is that it builds up your confidence.
Oh, yeah, of course.
And so after Bay Corp, in my early days at Coopers, I sort of had one win after another. And I was riding high and didn't think I could lose money on investments. And I covered the paper and packaging sector amongst other sectors. And I had a number of meetings with a company called Paperlinks. They were a global paper products distribution company. And had a good relationship with the CFO. I won't mention his name now. And he's the CEO of Bapcor today, actually. And generally the analysts were very glowing about the company, and management were talking about, giving a pretty strong indication that earnings were running well ahead of consensus. And without doing as much work as I typically had done up to that point and have done since then, I suggested we buy the shares. Not long after we bought them, the shares started coming off, and that led me to sort of uncover a few layers and do a lot more deeper work on the company, and sort of really understood that the business model wasn't particularly good. You're talking about a paper company with paper thin margins, number one. Number two, you're competing with the end customer with the paper manufacturers who are supplying you, especially in the European context, and with slowing European economy at the time, with super thin margins. It didn't take long with that the weak balance sheet was exposed. So that was one example. And another example that was a bigger percentage loss was a gold company. It was a single mine gold company, relatively weak balance sheet. It was theoretically super cheap, but it had a pit wall failure, and that basically wrote off the investment. And we probably lost 90% or something like that. And I think the lesson over there is a single asset company in the mining space with a flimsy balance sheet and a relatively high risk profile mine is very much a buyer beware proposition, but you can extend it beyond mining and beyond gold. Effectively, people should focus very much on companies that can last the distance. Things never go exactly to plan. Occasionally they do, but in general things don't go to plan. You get left field surprises, and you want companies, management teams and balance sheets that can ride out tougher than expected circumstances. Yeah, very sure. I mean, for me, the key thing is, and I think to all the listeners here, is everybody would have heard of successes. And that's why I really wanted to bring in losses, that do happen. I mean, failures do happen, and nobody will hear about that. And I think it's more just a buyer's beware, or know what you're doing to some aspect before you jump in. Yes, there's people that make money in a volatile environment like we've been in, and there's gold stocks and resources stocks that do make a lot of money quickly, but they lose a lot of money a lot quicker. So I think it's just be cautious, tread caution, and have a bit of you can say seichel when you're making an investment. I think just one of the sort I really think is valuable, and I think a lot of people here would, is do you hold a company for a long period? Do you hold a company for a short period? Do you take profits? Do you look for value? I mean, I've been speaking with people over the past few months, and they've held on to stocks that were doing incredibly well, and then COVID hit, and they're literally back to a position where they were 5 years ago. It begs a question: do you hold companies for a long time? Do you hold it for a short time? I mean, Natasha, maybe I'll start with you. Is it to take a long position, or do you take your profits and take your wins?
I think I think the art of investing is not just when you get in, but when you get out. So it doesn't matter how much the price rises. A good call. If you don't exit at the right time, then it's a problem. Having said that, I take it completely at a personal level. There are really two aspects of my life. So the unlisted portfolio, which I have, which dwarfs my listed portfolio, which I actually actively am involved with, that I'm involved with the companies, I advise a lot of the companies, I'm certainly very close to the CEOs and the management teams, and I'm constantly assessing where value lies, because often these people are coming back multiple times for transactions. You have to have a view of where value lies. And then you've got the listed portfolio where, frankly, I don't spend enough time on it. Unless they're my clients, I'm not allowed to trade at all, and I can work for companies for 2-3 years at a time, which makes owning their equity a very long-term hold with absolutely no ability to sell. So alternatively, you hand it to people like Rafi and Mark who do this for a living, and they can actually get in and out of stocks, and they can trade positions, because I have to recognise that when we're involved with a company, as their advisor, we cannot be selling their shares. So even if I have a view that something's overvalued, I can't sell. So it's an interesting position to put yourself in. But I think generally, certainly in the private deals that we do, our view is very much focused on where underlying value lies, not so much because you don't have a live price, you don't have that measure of success of where it goes up and down. You have to come to your own views of value and whether or not you want to participate.
Yeah, interesting. Very interesting. I mean, I'll switch to Shaun quickly and ask him, and then I want to hear Rafi's view as well, and then Niv's view. All sort of deal with different companies and different investments. I mean, one thing I love that you said, Shaun, is I'd rather take 5 20% profits and 100% profit.
Yeah.
So, I mean, for me personally, not that I'm a big investor in any scope, but I like profits. I like to see the money, take the paper, off I go, and find the next thing. Your sort of view on that?
Yeah, well, we all like profits. But, yeah, I mean, my view has always been to take 20% 5 times, and I guess what I'm doing is all very short term. So, look, you make 20% on a trade, you're more than happy, especially if it's in a day or two. So, yeah, it's a lot safer to go for those 20%ers quite a few times and hold on to something and try and double your money, because if you're going to double your money, there's risk there, and you've got time risks, so you're holding on to a stock, and it's normally going to take a long time, and then you've got all the market risks. So, I mean, I often ask myself a question when I'm holding a stock: would I be buying more? And if the answer is no, then that's something then I'm going to look at selling.
Yeah.
So a lot of people, they may be up on a share and they could ask themselves, would I be buying more? And if the answer is no, it's probably time to get out. So, yeah, it's
That's a good way to think of it. Absolutely. I mean, there's no right answer. I don't think. There's two. One person said to me a few weeks ago that if they had an opportunity to buy Seek, many years ago, to get in at seed capital, sort of, on the IPO, and they sold out when they made their money.
Got in seed,
yes.
Seed round Seek.
Yes.
I think I sold like a day after listing.
Yeah, and now they're...
That's typical across all your investments.
Yeah. Here we go.
You never buy more.
I'll have to we'll save the banter for
it. Look, Niv's got me quite a few good deals, and if I'm up on them, I'll sell, but I'll get a call 2 days later saying, "What are you doing selling my shares? You told me you're going to hold." It's like I told you every time. Yeah.
I mean, I might switch to Rafi, and then obviously Niv can give Shaun a bit of banter back. But Rafi, I mean, in terms of the fund, and not to go into too much detail, but buying and selling and holding. I mean, when do you exit? Do you have a strategy straight away?
I think there's definitely a difference between a private investor investing a single stock and running a fund where you're always effectively invested, and it's a relative valuation question between your opportunity set. But on a broader level, my favourite investor is a guy called Stanley Druckenmiller, famous US hedge fund guy. he came to fame because the famous trade of George Soros shorting the pound was actually his idea. The value that Soros added was that if it's such a good idea, let's go harder. And over the last 30 years, without doubt, Stanley Druckenmiller has probably been the best global hedge fund investor. He runs his own family office now. One of his famous tips is to effectively look at where a company is going to be at in 18 to 24 months and then trade it accordingly. And so effectively you want a company that's going to be more valuable in the market's eyes in 18 to 24 months than it is today, and buy the discount of the view that goes towards there. Now often while the market is a long way off the mark today on where it's going to be in 18 to 24 months, it doesn't take that entire period for the market to change its view, either because brokers are upgrading earnings, or because the company does a presentation, or because the sector becomes more popular. There can be a lot of catalysts that bring forward the reward from that 18, 24 month time closer to today. But my perspective is when those benefits, or when the upside that the market wasn't understanding in the stock story is reflected in the share price, and it can be a day after you buy, or it can take 3 years. But when the market fully reflects what you already know today, that's the time to sell. And I think on stocks where you have like a strong research-based angle, you can afford to hold for a lot longer if there's a high level of conviction. And so like the biggest stock in our portfolio today is a company called Chorus. It's the NBN of New Zealand. The difference is it works. It's quick. We've held that for quite a few years. It's up 4 or 5 times since we bought it. We still think there's a long runway to go for the stock, and the fact that we've done well in the past doesn't change the fact that it's still trading at a steep discount to our valuation. And so we're very flexible. There'll be situations where we'll buy a stock and a week later it trades towards our valuation and we'll exit the position. But I think the important thing for people is to ignore what the shares have done either in the recent history or the longer history, and really focus on how the facts underlying the valuation stack up with the share price today, taking a constant fresh perspective of all the information that comes along the way.
Yeah, absolutely. And I will talk after I get Niv's point of view, is I will talk about how to look at evaluation of a company, and just in very brief terms, so that people who haven't had the opportunity to invest or are looking to invest know sort of some of the key things to look for. So Niv, now you're saying Shaun gets out really early, too early. So there's obviously Shaun's missing out on some profits. Does that mean you're getting the other side, or is?
Sometimes. No, look, I mean, where we play is probably in that sub 50, sub 100 mil enterprise value companies, where we feel we can take a big position and a big shareholding and influence management, right? So look, we've had some great success. Seafoam was up 4 times, and now it's 1/10 of the value, for example. I mean, Golden Mile Resources. No, I think you sold. You made money on the market. Did very well. Went up 3x. Golden Mile, it was up 8 times in the space of a month, and now it's back way below IPO price.
Lucky I sold.
I know you made some good money on that as well. Lifespot Health doubled on debut. You did very, very well. So, so he's on a hat trick at the moment, as you can see. But no, look, the reality is you have to back good management teams, and sometimes, like Rafi's saying, I mean, when there's a disconnect between the management and the valuations, and where you believe the fair value of the asset, then it's time to exit. So, especially in the small cap land where they don't have earnings, a lot of them, because they might have revenues, but they don't actually have any free cash flows and dividends or EBITDA. You're buying, I don't know if you're buying hype, but you're buying the potential. Yeah. Right, and when it comes down to investing in potential, that's something that you need to always back the good management team. So absolutely, you sometimes don't get them all right, but it's coming back to in a small cap land to try and manage the risk as you go up, and definitely take money off the table. So I mean, I'm thinking that there's probably a few people listening that look at the shares and they say, okay, we've got a share at 5 cents, okay, versus a BHP at $36. And there's more chance of me doubling my money on a 5 cent share versus doubling my money on a BHP share.
It's a high likelihood of it going
Exactly. It's high likelihood of it going to 1 cent.
Yeah,
So
the reason why it's 5 cents.
it's very true. Absolutely. So I mean, I guess the question is for people looking at these companies, how do you value such a thing? Like how do you really put a value on companies when you look at a BHP or you look at a penny stock essentially that you're really trying to speculatively or gamble that it will double? I mean, how do you value a company, Rafi?
I think the one unusual thing about the share market is, in every other area, people assess value versus the product they're getting. Often in the share market, people view shares as some sort of abstract item where they don't sort of try to compare what they're getting with the price they're paying. And so when someone wants to buy a new car, obviously, depending on your taste, a Ferrari is a fantastic car, but no one goes into the showroom and says, I'd like to have that because it looks good. They might say that, but they'd also ask what the price is. And similarly, no one goes and asks for the cheapest car without trying to take it for a test drive. It really is a balance of getting good value for what you're paying. And so in terms of value, the way we think about value, and I'm sorry to go off-piste a little bit, but I think it's incredibly important for anyone who wants to get into the investment business to do lots of reading. There's years and decades and generations of accumulated wisdom that one can't just pick up messing around on the weekend. And so before I started my job at Cooper's, my first job in the industry, I went for a holiday to Thailand, and Peter said, here's a couple of books you really have to read before you start. One of them is One Up on Wall Street by Peter Lynch. It's an easy, fun read. Another one is The Intelligent Investor. I've got lots of other suggestions, but they're the two that I'd say start off with, and they sort of cover that topic. It's really hard to do very quickly, but effectively when you're buying a company, you're buying the future earnings or cash generation of that company from now until the end of the company life. And so what we want to do is make our best assessment of what that cash flow generation is going to be, and then work out when it's going to happen, and then discount back the value to how much that future cash flow is worth today, because $10 in 100 years' time is less valuable than $10 tomorrow. That being said, with low interest rates, the gap narrows a little bit. But what we really try and do is assess that future cash flow that really belongs to shareholders. There's lots of extensions to that in terms of the profits, how they're going to be reinvested. Can they be reinvested in a high returning sort of way so you can keep growing the business over time above and beyond what exists today? But I think the most important thing is really to understand where do the earnings come from, or the future earnings, how robust they're going to be, and how valuable they are to me today. It's just to look, what the biggest mistake someone can make is say the shares have gone up a lot, therefore they're a good company, or the shares are a lot cheaper than they were 3 or 6 months ago, therefore it's cheap. That's not an effective way of trying to assess value.
Very, very true. So just on that, as a listeners, the book that Rafi mentioned for anybody to read was One Up on Wall Street, as well as The Intelligent Investor. That's right.
Ben Graham.
Yeah. So really good books to read. I would absolutely recommend them as well. So, and then on the different side, I mean, I'll cross the table. I feel like I'm, there's two different parties here. It's two different views, which is good. That's what we sort of wanted. So, Shaun, I mean, you're, as we mentioned, very short term. Do you put a valuation on a company on your side? I mean, or is it different?
You can't. So if you talk about that 5 cent share and you try and use Rafi's net present value or discounted cash flow, you just can't, because most of them are selling dreams. So you can't.
Of course.
Yeah, it's impossible to use those sort of metrics on a little penny stock. So I guess the best way to look at the value is what the market's trading it at. So where demand and supply is, and I guess you're trying to. A lot of people are using technicals rather than fundamentals, and for those people that don't know, technicals is when you're looking at the charts and the volume and the price and the past movements, whereas Rafi's talking more about the fundamentals. If Rafi came and analysed some of the stocks that I'm looking at, he'd probably be laughing, and he'd be like, he wouldn't put any money behind them.
Yeah.
But yeah, the 5 cent stocks are the ones that have got much higher risk reward. So
Of course.
the chance, as Natasha said before, it's more likely to go to 1 cent, and most of them do pretty much go like that and down over the long term. And the only reason why they are listed is the access to capital.
Yeah.
So yeah, look, there's a lot of them offer the blue sky dreams, and there are the few that over the long term will make people a lot of money, but you've got to know when to buy and when to sell, and
Of course.
when to take profits. And in small cap world, there's always missed opportunities, and you just got to be prepared for that.
Of course. Yeah. Absolutely.
Yeah.
I think the risk, as you said, is the return can be greater, but
Yeah.
on a 70-30, the risk is probably on the downside 70 and
Yeah,
upside
exactly.
30. If and that's probably going a bit high.
Yeah. So, I mean, there's not a lot of people that get it right. I mean, Niv will always say he got it right. So, yeah, I mean, he's always confident.
He's always getting it right.
How good he is. So, it's not that easy out there.
Yeah. And then, Natasha, I mean, thoughts on that? I mean, I know when we spoke very much, looking for value, it's...
I think I sit somewhere between the two. So I think, the share price is always a measure of value. It's someone said it's worth that, they're prepared to buy or sell a share at that price. So you have to be aware of what that is. But I think you can't, I think even with companies without earnings, you have to have an underlying view of what they could do from a cash flow perspective. And you have to have an underlying view of what their addressable market is, how they acquire the customers, can they do it, are they actually delivering a service of value, who's that valuable for, and frankly, are there enough of those people to justify the hassle of starting a business and actually delivering a product to them. So the classic example we see a lot of is companies that come and see us that have what looks like a great idea that solves an addressable market of 10. So there's 10 people in the world who need this solution. That's fantastic. It's a great solution. It's very valuable for those 10 people. There's going to be an inherent limit on the value of that business compared to something which you can literally sell to millions and millions of people. And so I think when you're looking at the unit economics, so in order to do the sort of analysis that Rafi's talking about, we do that for even small companies and early stage companies and unlisted companies, because our view is you have to have a view of the addressable market, you have to have a view of the unit economics of acquiring the customers.
Yep.
You have to have a view on, is this management team going to be able to make the right decisions to capture that market? Are they going to be able to withstand the normal shocks that come at every business? But they're doing that usually absent a balance sheet, and usually absent like a validated customer value proposition. It'll be somewhat validated, but it will have some limitations. So particularly, we do M&A for very large businesses and we buy established businesses for people. But we also invest in very early stage companies where we're literally having to form a view about addressable market, around purpose and around values. And that's a bit more philosophical, but the underlying result is the same. Now that doesn't work if you're trading in the timeframes that Shaun's trading. It's not possible because that work can take weeks and months to finish. It takes, you have to develop your own understanding of the market in a sense to test whether the founders and the management teams you're meeting with have a viable way forward. It doesn't mean that trading a stock in a day or two is a bad thing. It's just a completely different activity. It's not really correlated. And that's why I say, from my perspective, I don't do that because that's not how I roll.
Yeah.
But it's, as you said, it's a completely different aspect of where the market is, and there is a massive and increasing part of the market that is trading on technicals, that is trading, that are trading, that they're essentially trading through computer platforms. They're trading faster than we could ever imagine. And if anyone wants to understand just how different share trading is from when we all were talking about privatisations. The first we all talked about shares in Telstra, shares in Tabcorp, shares in Qantas, shares in CSL. Wouldn't that be lovely? But now the market is so different in terms of dark pools and multiple exchanges, day trading, and it is worth reading if you're interested in getting involved. It is worth reading Flashpoints by Michael Lewis, just to understand that even if you are a value investor, you have to be able to understand that there's a massive volume in the market that are not.
Interesting.
And
Yeah.
they are going to move the price around whether you like it or not. So you've just got to be mindful of that.
Yeah. Very interesting. Very true.
I mean, you saw it today
Then
as
if-
well.
yeah.
There was a company, I don't know if you saw, I think it was ESK,
Yep.
we were talking about, that moved up 1,300% in one day on the back of an MOU, right? It made absolutely no sense. So take your financial models, take your cash flow analysis, take your NPVs, and things just don't make sense,
Of course.
right? I mean, having said that, there are some companies in that sub 1 or 2 cent level that are actually real companies, right? And unfortunately, they've inherited a shell, and what I mean by that, there was a core business that they vended into another ASX listed company, and
Yep.
they've got, let's say, 1 billion shares on issue, but the core business is actually a real great business, and they just wanted to go in and get a liquidity and raise capital, and a perfect example is a company called Digital Wine Ventures, DW Wake, that the CEO, Dean Taylor, had 7 ventures for 7 exits. He started a business called DeWine, which is disrupting the whole supply chain management of wine for same-day delivery. And they've got a partnership with Australia Post. Now they're starting to really ramp up. The number of orders starting to ramp up, and we're up 3 or 4 times, call it, at that level. And at that level, you start to say, well, wow, is this business a bit now at that 25 million market cap? We were originally at 4 or 5. Is it expensive? Is it cheap? But then, do you want to, do you think there's upside?
Yeah.
And where the upside then becomes is they're building a B2B marketplace where they provide essentially a sales channel as well. So, look, there's probably upside, but at that level, you probably time to take some money off the table. And
Can I just butt in there and ask Nick a question? So did you raise money for Digital Wine
twice
at what price?
at 0.006,
Yep.
and then I think it was 0.0065 with a 1 for 4
And
option.
what price is it at now?
It's 4 times that.
Right. Everyone, Nick really wanted me to ask him that.
I don't need to answer that.
But I think so tell me, Niv, when did Shaun sell out?
Shaun sold probably at a loss.
I did actually money on that.
So the things that are up 4 times, and Shaun probably sold at a loss. Once again, quick trade.
Of course. You know what? I think it's that's a good example. A really good example. So I think one of the questions before I open up to sort of questioning, which I hope you guys won't mind if you've got a little while, and I'm sure there's a few questions, is to somebody who hasn't invested in the market yet, okay, who's sitting on the sideline saying the market's going up and down. I mean, when do I start? When do I get in? I mean, just some advice, and I'll start with you, sort of, Rafi. I mean, for the people that want to put 1,000, 2,000, 500, whatever it might be, 10,000, whatever it might be to start.
I think the biggest mistake private investors make is worrying about the level of the market.
Yep.
And focusing on, is the market cheap? Is it going up today, tomorrow? The key to creating wealth over time is to invest in really good companies gradually through the cycle and tinker with the portfolio to make sure you continuously invest in really good companies, but find companies that you like, that you believe in, and hold them for the medium to long term. Sometimes you'll be buying at the top of the market, sometimes you'll be buying at the bottom. You'll only know that in retrospect, but don't focus too much on where the market's at. Are there going to be 65 or 200 cases of corona in Victoria tomorrow? Is Florida cases going to be a bit higher, a bit lower, the death rate? Is the vaccine going to come in October or January? You can drive yourself nuts with all of that. Alternatively, you can say there's lots of good companies that are going to be better over time. And if you look over a 50 or 100-year history, something like that, the Aussie equity market and the global equity market's probably going to do 8 or 10% a year, or 6 or 7 over weaker stretches. And if you can buy some pretty good companies, you can do substantially better than that. That's your best chance for creating value over time. Just focus on really good companies and worry a little bit less about the market direction.
Yeah, very, very good point. I mean, and Niv, your sort of thoughts on that? I mean, obviously, I think when we said, like, you and Shaun obviously dealing with the smaller companies that have a lot of risk. Not all of them, but what would you sort of suggest? Similar advice for a person starting out?
People starting out, look, it's really interesting. I mean, now there's all these, Twitter obviously took part last year, and now it's the Facebook, call it age. I mean, there's groups now that have 20, 30, 50,000 members, right? It's really, really interesting. I was speaking to actually a few, they actually set up a few of these, and a lot of them actually don't have a really strong knowledge of the stock market. They just landed themselves into it, and now they've got 20 or 30,000 people that follow them. It's pretty scary what's happening in the market in terms of the trading volume, and Natasha mentioned about high frequency trading and the pools and what's happening with sophisticated investors as well. I think you just have to be vigilant. I think you just have to follow a trading plan, right? I think it's really important to realise that if you're making $200 a day, that's $1,000 a week. If you're doing $1,000 a week times 52, that's $50,000. That's an income, right? That's an income. So I think just build it up slowly. Don't be too scared about locking in profits. Cut your losses when you can. Let the profits run, and protect your profits with stop losses and gradual stop losses to manage your risk. I think that's really important. So that's what I would advise.
Would you, I mean, if I asked you, Natasha, would you say if somebody's got a few $1,000s to invest and they want to see how they go, I guess, or have a chance at, investing in the market, would you say they've got to be prepared to lose that money?
So I think if you're investing in the market and you don't do your homework, then you may as well go down to the trots and lay a bet. That's essentially what you're doing. You're investing in things you don't understand. You can't assess the risk, and you can't price the risk. What you're really then trading on is a gut feel. And you could bet on football, you can bet on horses, you can bet on the stock market. It's still a bet, and an uneducated bet is a very high risk activity. If you like it and you like betting, then that's what you're doing. You're entertaining yourself with betting, but that's not investment. If you want to invest in the market, you need to understand the things that you're investing in. And my advice is you either need to take the time to actually do your research and understand what you're doing, whether you're a day trader and you're trading technicals, whether you're a longer value investor like what Rafi's doing, or the private investor like what I do. But you have to take the time and you have to do the work, and there are no shortcuts. If you don't want to do the work, and it's completely legit, if you're an engineer or an accountant or a doctor or something else, or a tradie, and you don't have time and you don't want to punt, but you want to have exposure, then there are mechanisms to do that, whether it's through Rafi's fund, whether it's through an industry super fund, whether it's through another mechanism, or whether it's through an LIC or some sort of ETF. So it's interesting. My son, my eldest, just had his bar mitzvah late last year. And thank you. And it was very exciting, and his grandparents gave him some money to invest. And we've actually chosen to put him into index funds because, one, it gives him a sense of put a little bit of money into a global index fund, we've put a little bit of money into a tech index fund because he was interested, we put a little bit of money into basically an ASX 200 index fund. One, because it's not a massive amount of money, so we can't really invest in a hedge fund like what these guys do. Two, it gives him a sense of what those funds hold, and he can look at the underlying stocks and learn. And three, he can say, okay, Mum, I wanted to invest in Google and Facebook. And we're like, okay, Jakey, you now have a very microscopic position in Google and Facebook, but you do. You have an exposure to that market, and you have an exposure to that world, and you can learn. So there are now very cheap mechanisms through the listed market where you can effectively buy a portfolio of stocks. You're not going to get outperformance, but you will get what Rafi described, which is the average market performance of that bundle of stocks. And for a lot of people, that's not a bad way to start, and allows them to learn a little bit, allows that to have maybe not such a high risk, not such a fabulous, you're not going to get your 3-5x, it's just not going to happen, but you're also unlikely to go to zero. And so it's really that balance, and in making your investment decisions, you do need to think about the risk as well as the reward, because it's part of the game.
Absolutely. And then, Shaun, I mean, you got fed up with the blue chips in your first investment.
Yeah, so maybe I'll change the question a bit to what I'm always asked, and that should I start trading, should I start day trading?
I think because everybody loves the idea of being a day trader.
Exactly.
Everybody loves that idea.
It's not as glamorous as what people would say. There's a lot more to it than working 10 till 4. So, I mean, my answer to those people is normally the same. You've got to be able to learn from your mistakes, and you've got to be able to make those mistakes and not blow all your capital. Because I've seen a lot of people that start and blow their capital pretty quickly, and you don't really have time to work out then is it for you or is it not. So I guess I'd mirror what Niv said before, just go small. Just making $200 a day is not bad. if you have to do that for a year and you do make that money, then next year you can always go a bit bigger.
Yep.
But yeah, just be able to learn from those mistakes and learn what you did wrong, and you've got to give it a lot of time. And as Natasha said before, and I think especially for trading, you need to do that extra research.
Yeah.
You can't just work that 10 till 4 and hope that you're going to do your magic then, and you don't need to do anything else. There's a lot of research and finding. You need to learn about the companies, what area they're in, who's. I mean, like often I won't look at the fundamentals, but it's often important to know who's running the company.
Yeah.
And, a lot of bad people, let's say, in small cap world, and there's a lot of bad things happening, and you just got to be really careful, especially if you're prepared to take a punt on one of them and hold on to them for a while, then you're putting your money behind these people. That
Didn't you warn me about the latest deal about David Breeze on BP8 and he made double money?
Here we go.
Oh, you mentioning names. I hope Mr. Breeze isn't watching tonight. I don't know, he's not a young Jewish professional. Yeah, look, we are backing people like Mr. Breeze, and when you are, you're just keeping it short term.
Yeah.
And that's the less time you're in, the less you're exposed. So,
Absolutely.
look, I did give Niv a warning or two about getting in bed with Mr. Breeze. He.
And you
Well-
got the money, so that's good.
I did double my money, but there was a lot of headaches with that. And,
Well, I think, you know what, the wonderful thing is that we've got really, various views, which has been fantastic. We've got various views, and yet a lot of people sit around and say, Shaun, the day trading side it's a phenomenal dream for a lot of people.
Yep.
Look at the market and they say, oh, I want to get into day trading. I really, that's the idea, be at home.
don't do it.
Trade-
Don't do it.
And then you've got, hopefully we've got a lot of other people who want to get into the investment side and, want to look at value and help companies in terms of, growing them from the ground up and being a long-term investor and, being a part of funds. And then, with Niv helping, companies raise money and, hopefully benefiting on that side as well. So now I will open up the question. Now we've got a lot of questions here. So I thought I would just sort of, I'll do a couple. So we had one from Aaron Werdigaz. We said, Niv, speaking of speculative thoughts on ESK today. It came on the market at 18 cents and it hit a high of $2. I mean, that's market hype, I'm assuming.
It's all hype.
Yeah.
It's absolutely hype. There was an MOU announced with Samsung. There was no numbers around that. So when you're looking at the announcement, there was no revenue, there was no guidance, there was no, ways to really, for the market to assess, is this now worth over 200 million market cap or not? Well, it probably isn't. And I was having a laugh before we started to Rafi, can we borrow the stock? And it's going to be very hard to borrow the stock because we've actually shorted the stock. But no, look, ESK had a big run, and you do see things in markets that just simply don't make sense. You sit there and you scratch your head and say, it doesn't not make sense. And if it doesn't make sense, if there's no fundamentals around it, then my advice is you take your money and you move to the next one, because if you hold it for too long, you're going to get burnt. So that's my biggest.
Interesting, very, very speculative. And I mean, I remember a couple of weeks ago talking to Shaun, and you said in your time of investing, and it's probably the same with you, you've never seen a market like it is at the moment. In terms of how choppy it is and how,
Yeah, look, it's hard to believe that we're in the middle of a major pandemic and the way the markets are moving at the moment, especially smaller micro caps, it's pretty much as good as it ever has been. And in the area that Niv and I are working in capital raising at the moment, it's every day there's just more and more capital raises and so heavily oversubscribed.
Yeah.
Which we haven't seen for a while. Everyone just wants to put their money in stocks and speculative ones as well. There's a lot of quick money that's coming into the market.
Absolutely. I will also ask a question. This is actually a really good question that's come out from panel. Mark Cuban once said diversification is for idiots. Thoughts on whether it's better to diversify versus investing in individual stocks? What are your thoughts on it, Rafi?
I once ran into Mark in Vegas, and he's a pretty credible guy, and he's made a lot of money, picking huge 100,000 time type stories. Very few people are going to succeed that way. So to the extent that, you pick the next Amazon or Microsoft or Facebook, there's nothing you can do that's better. The probability of putting a large amount of money into one of the world's top 10 success stories is very small. And so, it's, from my perspective, it's really a situation of, over time, the snail often wins the race, and one gentle step forward at a time, and you'll have a few steps forward and a few steps backwards. But if they're cautiously taken, you end up getting to a reasonably good destination. It might not be the same destination as Mark Cuban, but it's a reasonably good destination. For those people who have a huge risk appetite and have a genuine self-belief and skill set, I wouldn't discourage them from having a crack at hitting the ball out of the park, but just be aware that most times you're going to get bowled out.
Yeah, interesting. So I guess I'm thinking while you're talking as well, I mean, when you go to the casino, very different, and you look at a roulette table, you don't put all your money on high or 18, you spread it round. So I mean, diversification is...
I mean, talking about going to the casino, for me, it's always much more interesting to invest in casinos than lose my money at the casino. And so I think, there is a whole world of COVID trades at the moment, pro and anti-COVID trades. And I think, one of the interesting ones is a company like Star Entertainment. They've got casinos in Sydney and Queensland. They've spent a lot of money on CapEx over the last few years. They were closed over the last couple of months. They're now gradually reopening. Without promoting the stock per se, there are a whole bunch of companies like this that are going from a really low base of earnings and expectations in a normalising world. And sometimes you can make more money on the casino than at the casino.
Yeah, interesting. Very true. Very good. I've got another question. There's quite a few actually coming through. So, question for the panel, and maybe I'll ask Natasha this one here. Should we be investing out super more actively, as been discussed, or leave it for the super funds?
I think it just depends on your ability to spend the time and your skill level. So if you have the skill level and you have the time, then managing your own super is a very interesting and fulfilling way to invest, and a lot of people who do it very effectively. If you're not doing your research and you're basically punting, then you're punting your retirement funding. If you have a lot of retirement funding, maybe you have some surplus cash to punt, but I think you need to balance it with the risk. So, I really do believe it takes time to invest well and to actually make money in the market in a structural way. It actually requires focus, like with anything else.
Yeah.
And people tend to do best at the things that they're passionate about. If you're passionate about investment, then absolutely, it's a legitimate way to spend your time.
That's great. Yeah, absolutely great advice, I think. Now, views on Shaun. I might get you to have a answer for this one. Views on and when we can expect a market correction. Is it coming? I mean, the US is in turmoil. It's still going up. I don't understand it. No, I don't think we could all sort of say when the market's going to turn. But thoughts on it?
Oh, look, yesterday I thought we were going to have a correction, and the Dow fell 700 points on Friday night, and I think everyone was saying, okay, our fund's finished for now. We're going to have a correction, but then last night it goes up 500. So I think everyone's waiting for it, but it just doesn't seem to want to reflect the economy and the struggles out there. And as we said before, there's a lot of money in the sidelines that needs to go somewhere.
Yeah, of course.
So there's a lot of printing of money, and with cash rates so low, people are putting it into the market. So, look, I feel like there should be a correction, and we're probably not trading at where we should be. But I guess we'll enjoy it while it's there.
Absolutely.
While it's going up, we've got to just enjoy it, and just hope it doesn't have another big correction.
Yeah.
But,
And I think, I mean, being more short term in terms of the trading side, is that something that you worry too much about?
yeah, look, I do worry about it because I'm not only day trading, I'm holding on to things for a lot longer. And especially if you're planning on holding things, say, for a week, you've got big exposure to markets. And it can turn so quickly, as we know. And as Rafi said before, when you're worrying about the COVID numbers and if there's 65 cases or if Florida, whatever, that things like that affect the markets daily. So, look, there's definitely feels like a big disconnect between the markets and what's happening out there.
Definitely.
So,
Interesting. Okay.
sorry I couldn't give a firm answer.
Nah, that's all right. No problem.
I'd be sitting where they're sitting.
Perfect. All right, we've actually got quite a few more coming through. So, hey guys, thanks for the amazing opportunity. Around 7 months ago, I started trading in Forex. This is one for you, Nibby. I'm still learning, but starting to freak me out because I'm not consistently profitable. I can work for free for you guys to learn and become a professional trader. Can you help me, please? What sort of advice? Obviously, Forex is a different one. I mean, we talk about the share market being a beast. Forex is probably a monster beast, or even worse.
I mean, my experience, I've done everything, right? So from options trading to CFDs to Forex to buying soybean futures at 2 in the morning and getting stopped out, right? And lost a lot of money, right? And
Soybean futures.
Soybean futures.
Guys, never touch
Don't
soybean
invest in
futures.
Soybean futures. If you've done any research on soybeans.
Sounds like Eddie Murphy.
Seriously, trading places.
But look, Forex, it's a different kettle of fish. I mean, you're leveraged 100 times.
Crazy.
You need to set up clear strategies and stop loss and manage position sizing, and it's a 24-hour market essentially, give and take. So it is the most liquid market in the world, right? From that perspective, where stocks could gap up, can gap down. Forex actually could, essentially you've got that liquidity all around as Europe, America, then goes around to Asia, etc. So look, it is short term. You need to be very vigilant. You need to understand exactly what's happening, not only from a news flow on the macroeconomic side, but also the technical analysis side. It's a different type of trading, but my experience with Forex, and look, leverage in itself, I've never had success with leverage. I mean, initially you do. I mean, I took a $5,000 account on leverage when I was actually $21,000 to $100,000 and lost all of it, right? My experience is to make money, you have to back good businesses and use your cash and just build it up slowly. That's my advice.
When you refer just on that to the leverage side for people sort of watching, I mean, you take $1,000 and it's leveraged up 100 times. So you're actually, although you're investing $1,000, effectively you're trading with 100,000.
You're highly exposed.
Yeah,
You're
it's.
highly exposed. You need to be very, very careful.
Guys, we won't do a session on Forex. I don't think so. I think we might get ourselves into trouble if that's the case. Rafi, maybe for you here, just what are the basics in assessing a company balance sheet? I mean, it's you could probably talk about it for a long time, but the real basics.
Sure. So before 2008, 2009 recession, professional fund managers spent almost no time looking at balance sheets because good Aussie companies never went bust and they never needed to do emergency raises, almost never. And so you learnt about it at university and then you went to work, and when you did your model you filled in the balance sheet, but that was a very small part of your thinking and your time. Then the GFC hit, and then you realised the significance of balance sheets because there's two issues in terms of a balance sheet. One is the absolute strength of the balance sheet of the company. The second thing is the liquidity of the company. And so, for example, one of our best investments ever was Macquarie Atlas Toll Roads post GFC. They had less leverage than Transurban going into the GFC, but Macquarie left it with a balance sheet where the debt was relatively short term, but the assets were very long term. And so when the GFC hit, you couldn't refinance, and so a super safe asset ended up being refinanced with interest rates north of 10% and rapid repayment schedules. And then so as things normalised over the next few years, interest costs went down from 10% to 0% today, and shares went from 50 cents to $7. But sort of taking a step back to the balance sheet, in essence, what we're looking at is the assets of the company. Are they liquid? Can they be readily converted to cash? And then secondly, the liabilities, and we're looking at both debt either to banks or bonds, also receivables and payables. We're looking at fixed charge cover. So if you're a retailer, you've got lots of stores that are leased, that long-term lease is a commitment. And so, for example, a company like Qantas, the balance sheet was very much in question when the company stopped making money a few months ago flying planes. They've still got a lot of obligations. They've still got to make lease payments, interest payments, staff. They've got losses on their fuel hedge book, all those sort of things. And suddenly, not everyone wants to lend into an airline when it's not operating. But one of the positive things they had in the balance sheet was a lot of unencumbered aircraft. And so they could take those aircraft as security, go to financiers and draw down debt at relatively competitive rates against that. And so it's very hard to describe a generic explanation of balance sheet. It's something that people have to do a little bit of reading and thinking about. But effectively, you want to know that if earnings go through a rough patch, that either you have enough cash on hand, or you got bank facilities that you can draw down, or you got assets that you can either sell or you can borrow against to fund your requirements until things stabilise.
Yeah, another example of that is actually Centro. So Centro is an old example now. It goes back to 0809.
Centro shopping centres. Yep.
So shopping centres, you would have thought that was a really solid business. They own good shopping centres. There's really nothing wrong with the business other than the fact they had a stupendous amount of debt, and that debt was effectively short-term debt. And it was misclassified on their balance sheet as long-term debt. And so the market actually wasn't aware. And again, it was pre-GFC. There probably wasn't a focus on the maturity of that debt. But that company, in effect, failed. The equity was written off to zero because they messed up the duration of their debt. So particularly when you're looking at volatile times, you have to look at, as Rafi was saying, you're looking at the cash, you're looking at the net working capital, so the receivables and the payables and how they move. And then you're looking at the debt and when's it due and can they refinance. And there are always examples. We worked for a company where we recapitalised the balance sheet, and even though the debt was current, the bank supported the business. And banks are supporting a lot of businesses at the moment. They really don't want to foreclose on businesses at the moment. But there are businesses that won't get through despite that, because they just will not be able to generate enough working capital to get through the trading conditions at the moment, which
Absolutely.
are very difficult.
I might just add one more thing.
Please.
Effectively, you can only ever trust your own work in terms of investing. Like there are good financial advisors, there's good brokers, there's good management teams, but at the end of the day, it's your money and it's your responsibility to make sure that you've done the work. And so, for example, if you look at companies like a Webjet or a Flight Centre at the moment, the balance sheets look fine going into the crisis, but in reality, they had a lot of the cash that was on the balance sheet wasn't their cash. It was actually the client's cash that was sitting there in prepayments for flights. And so when the flight stopped, they have to give back their cash. And so suddenly they go from no debt on the balance sheet to a lot of debt on the balance sheet within a period of 4 or 8 weeks. And so it's not, just because the company tells you we're fine, doesn't mean they're fine. You have to really understand what's behind the numbers.
Absolutely. Very, very true. I might do one more question, guys. I know there's a lot coming through, and I'm sorry we're not going to be able to get through all. These guys are very busy. Niv has to go and trade some soybean stocks, and Shaun's got to look at the market tomorrow. So what's going on there? But I think this is a really good one, maybe for you, Shaun, if you don't mind. One more question: emotions and feelings in the market. That's something that people really have to. I don't think you can get right, but there's a lot of emotions and feelings that come into trading and buying stocks and shares.
Trading is a psychology. You got to really. I've often come into work in a bad mood, or I don't know, my wife annoyed me, or something like that. Liv probably called me in the morning. I don't know, and the lesson for that is just don't trade.
Yep.
Because if you're not in the right state of mind, then you shouldn't be trading. You've got to be. Look, something that I think we've all touched on before is you've got to be prepared to take losses, and that does get to people. Some people can take it, others can't. So if you can't take the losses, trading or even investing may not be for you. So you've got to put all that aside, and on a daily basis, I'm dealing with missing out and what could have been, and
of course,
losing money and
selling too quick.
Of course, and
not really. I don't think you ever complain. Selling too quick.
You're never going to get it right. You're never going to get it fully right. So it's a matter of being happy with what you're doing, and look, if, as we said before, you've got to have a strategy and you've got to stick to it, and if you can't take losses, then you may need a different sort of strategy.
Yeah, absolutely.
Maybe put your money, say with Rafi, or in a complete blue chip that you're going to hold on to.
Very, very true. I'm sure there is a lot of people here, just before we finish up, that are thinking, how do we work for you guys? And I'm sure there's a lot of people that are interested in this market. A lot of people love it. I guess a key question is there opportunities, to get in touch at some point, and or that was sort of one of the questions. Not to put everybody on the spot, but ideally, I think there's a lot of people thinking, how do they get into this?
Yeah, so we've got for those who are interested, a morning note and an afternoon note. That they can email me directly to get access to that, and for those interested in learning more, we've always got getting interns and grads, so happy to chat. Happy to chat offline for anyone that does. So let us know.
Excellent. And Shaun, 180 Markets is still new. Wonderful.
Yeah, so 180 Markets is only 4 months old.
Yeah.
So we've got a weekly newsletter which basically covers off the week in placements. So any capital raisings that took place during the week, you can read up about it, and also we release every capital raising through an email to people that are signed up. So go up, sign up, www.180markets.com.au. It's a little plug. And you can get access to heaps of deals and just learn from it.
I think those I subscribe to both those emails, and it's great. I mean, Niv gives us a daily wrap, which is fantastic. I really enjoy those. And Shaun, I sort of print Shaun's newsletter on a Friday night, on a Friday pre-Shabbos, I should say, and read it on a Shabbos evening. So that's great. And Natasha, in terms
we
of
have a pretty well-established intern program. We've got 9 people in the team, and
fantastic.
We've had a lot of people that we've hired as interns who've become grads and become really valued members of the team. So that's something we do over the summer. We're not interning people just at the minute, but we will be looking again probably in September to interview again for the summer, and we're more than happy to chat if people want to reach out. So our website's emadvisory.com. So
excellent. And I think what we will do is we'll get that put up afterwards for everybody to have a look at, definitely. And Rafi?
Cool. Well, if we're all plugging websites, I actually can't remember what ours is titled, but if you Google L1 Capital, you'll find it. I think one thing I can recommend to people is to pick a whole bunch of well-known fund managers, jump on their websites. Everyone puts out quarterlies. Have a look through everyone's quarterlies. Some of them are boring, but quite a few of them are very interesting. And if you read the Magellan Quarterly and Antipodes, and you pick 15 or 20 fund managers and read their quarterlies a couple of times, you get to sort of get a feel for what they're about and see who you like and who resonates with you, and then sort of get in the habit of regularly reading their stuff. They'll trigger ideas for you and thoughts on the market, and also give you an idea of if you're really seriously interested in the space, who you might like to work for, whose philosophy on investing kind of works with the way you tick. And I think the most important thing about investing for all the listeners is there is no one correct way.
Yeah, absolutely.
There's lots of ways to make money and to lose money. And, Warren Buffett might be the best investor in the world, but his strategy is not for everybody. Everybody has to sort of think through all the different experts out there and try to combine that with their own personality and work out something that works for them. And if people read through the L1 materials and they think, this is really how I think about the world and I'm passionate about it, and I think I could add to the team, feel free to send through an email. We don't do interns. We've tried in the past. We find it annoying, just because everyone's really busy and just training up people aren't going to be around. We just haven't enjoyed that so much. But we do regularly interview analysts and add analysts from time to time. And so, if you think you could be a valuable part of the team, feel free to send through an email.
Excellent. Guys, I think that's we will wrap it up. That's been amazing. Thank you, guys. I have to say to all the viewers out there, I feel really special because I've been sort of right in here talking to these experts, and it's to be on these guys are at the absolute top of their game, and we're so thankful for you guys giving up your time to come in and sort of give a bit of guidance and education. Now, this would not be a YJP event if we didn't introduce Moishe Khan to say a few words. Now, he would have loved to have been here, but he's at camp. So, Moishe, we'd love to hear from you. If you can unmute yourself and give us a bit of a quick address.
Hello, my dear friends. It's Moishe Khan. I am in camp right now, and therefore physically can't be with all of you. But I just wanted to thank all of you for joining us. I wanted to thank our wonderful, wonderful behind the scenes Zalmi and Brian who put this together, front of house. Brad, thank you so much for being a great host. Our panelists, Natasha and Shaun and Niv, and a special mention also to Rafi, who's been a real partner and friend of YGP for so long. It's great to have this entire really intelligent, dynamic, awesome group. Thank you so much. Thank you for joining YJP. We are live. We are going strong, and we look forward to welcoming you at our next event. Thank you.
Thank you once again, panel, and thank you all for joining. We had a great turnout and great numbers, so really appreciate you all coming, and we will see you again soon. And if there needs to be a number two, we will get in a number two. We'll just have to organise that again. So thank you, guys. Outstanding.
Thanks.
Thank you so much. Thank you. Good night, guys. Bye.